An analysis and grading of Alphabet Incorporated GOOG. Alphabet's revenue increased 14% year-on-year, slightly above industry norms, fueled by cloud, 32%, search, 12%, and YouTube advertising. Margins are strong. Gross margin sits at 59%, slightly below pure SaaS peers, but Alphabet shines in operating margin at 34% and net margin at 31%, thanks to its scale and efficiency. Alphabet is spending big on AI infrastructure, $85 billion in capex this year, nearly 20% of sales. Despite that, it maintains one of the strongest balance sheets in tech, with huge cash reserves and low leverage. Alphabet generated $66.7 billion in free cash flow over the last 12 months, up nearly 10% year-over-year. That supports buybacks, R&D, and AI expansion. Return on equity is 34%, return on invested capital around 25%, both excellent numbers that show Alphabet invests shareholder capital very effectively. Google Search, YouTube, Chrome, Android, and now cloud and AI form one of the most powerful ecosystems in the world. Network effects and switching costs are enormous. Future growth is fueled by AI, especially through Google Gemini, AI-powered search, YouTube, and cloud. Heavy investment today positions Alphabet well for tomorrow. Alphabet's RSI is around 84, deep in overbought territory. That's a warning sign. The MACD trend remains bullish, signaling strong upward momentum. Google is trading above its 50-day and 200-day moving averages, a bullish indicator. These oscillators show the stock is heavily overbought, meaning short-term pullbacks are possible. Momentum indicators like ROC and CCI are still bullish, reflecting buying pressure. Volatility remains elevated with ATR at 5.6% and ADX at 41 showing a strong trend. P/E ratio. Google, 22 times versus Microsoft 38 times, S&P 500 23 times. Cheaper than both Microsoft and the market. Forward P/E, Google, 18.4 times versus Microsoft 33.6 times. Attractive discount. EV to sales. Google, 4.8 times versus Microsoft 11 times, Nvidia 20 times. Cheaper than most peers, but higher than Amazon. EV to EBITDA. Google, 11 times versus Microsoft 20 times, industry median 15 times. Strong value. PEG ratio. Google, 1.4 versus Microsoft 2.0, Nvidia greater than 2.5. Growth-adjusted valuation looks appealing. Price to book. Google, 5.8 times versus Microsoft 12 times, industry median 6 times. Cheaper than Microsoft, in line with peers. Free cash flow yield. Google, 2.5% versus Microsoft 2.9%, industry 3% plus. Slightly weaker due to heavy AI capex. Weighted together, that's a 3.74 out of 4, which translates to a final grade of A-. Alphabet is a world-class business with powerful fundamentals and attractive valuation, though short-term technicals suggest some caution. That's our breakdown of Alphabet. Do you agree with the A- grade? Let us know in the comments. Don't forget to like, subscribe, and hit the bell so you never miss an update. Thanks for watching. This video is for information purposes only. It is not financial advice. Always do your own research before investing. This video does not suggest any action in terms of engaging in security trading of any sorts.